Welcome back. This is India Market Open. We're taking stock of the futures and options space. Well, consolidation continues. In fact, yesterday the Nifty closed flat with very little change in the respective futures open interest. The Bank Nifty, the picture wasn't very different. That was also marginally in the red with less than 1% added in OI. So it does seem like traders at the moment are sitting on the sidelines waiting for perhaps a trigger to come through, and then that's when they can determine a direction. But for now, this is how things stand. Even in terms of the options market, activity across several strikes has been very, very mixed. We are keeping an eye on your overall open interest distribution picture, which also indicates a 500-point range for the Nifty. Largely 23,000 on the lower end. That's where you have a substantial amount of puts being written. And on the higher end, we have the 23,500 call, where you do have a good amount of open interest distribution. Now, moving on to the Bank Nifty, it is the weekly options expiry. And at the moment, once again, it's the 50,000 mark, which will be a crucial level to keep an eye on, in and around there. And again, on the lower end, keeping an eye on 49,500, which would provide you with some amount of support in today's day of trade. Let's keep an eye. But let's move on and talk about stocks then. And of course, we have longs for Sun TV, GMR Airports, along with Oberoi Realty, and shorts in Interglobe Aviation and PI Industries. Interglobe Aviation, of course, saw a very large bulk deal yesterday, which is why it was under pressure. We had a key investor sell in there. But among stocks which saw unwinding, again, short covering for Tata Chemicals, MGL, Apollo Hospitals, along with Bharat Heavy Electronics. So keep an eye on that one. But on that note, let's get in an expert for today. Well, we have Amit Goel, who's joining us on the show. Amit, good morning. Thank you so much for joining in. Amit, the big events are out of the way. The dust seems to have settled. It does seem like benchmarks are now in consolidation mode. What is your reading, and how are you dealing with these markets?
Yeah, hi. Good morning, Agam, and thank you for having me on the show. Yes, the big event is out of the way, but the market is now kind of consolidating, waiting for certain key triggers, including the CPI data as well as the Fed data, which is due to the evening and tonight. So until we get a clear direction from those two major data points, I don't think the market is really going to be trending today. Having said that, I do have a slight bearish tint on the market, and I would look to probably sell the 23,500 calls for this expiry just to earn a little bit of income on the trade. But I will keep the yesterday's high as a technical stop for that kind of a trade on Nifty.
All right, but you have a structure that you're deploying on the Bank Nifty as well at the moment?
Yes, Agam. So I have a volatility arbitrage trade on Bank Nifty. I'm not really looking at playing the direction, but having said that, I do have a slight bearish tint to it. If I look at the forward volatility calculation estimations across the term structure, I find that the 49,000 strike offers me a decent vol arbitrage for the 26th and 19th expiries respectively. So what we would like to do is, if the market trends around in the range of yesterday's candle, we will look to buy a 49,000 put of 26th expiry, one lot, and sell the 19th June expiry of the same strike, which is 49,000. We will try and enter the trade having a maximum debit of about 2,400. With a margin of 24,000 rupees. The initial profit target here would be about 1,000 rupees per lot, Agam, which works out to a cool 3.5-4% on the trade. We will also keep a rupee stop loss of about 1,000 rupees per lot, or we could also have a technical stop if the price closes above 50,000 levels by, say, Thursday. If the market starts to trend on the upside, we could look to close the trade for a smaller loss. This is the trade for Bank Nifty.
Okay, so the logic behind this specific trade is very simple. In fact, you sell an implied volatility which is very high, and you buy an implied volatility which is very low. And what Amit is also doing is that he is dealing with the very same instrument but the only difference is that he is dealing with across two different expiries. So it is the 49,000 put in which he's buying the 49,000 put of the 26th June expiry. That's because implied volatilities for that specific expiry are low, which is why he's buying them. And of course, simultaneously, he is also selling the 49,000 put. This is the 19 June expiry. Why? Because implied volatilities are higher. And when he says he is playing an volatility arbitrage, this is what he's doing. He's trying to look and make the difference in terms of implied volatilities. As we all know, implied volatilities are nothing but a reflection of option premiums. And that's exactly how it plays out as far as this specific strategy is concerned. Amit, if I'm correct, and if there is any more additions, please go ahead and make clarifications.
Yeah, so there is one small addition which I'd like to make. You have already put it very elaborately and succinctly. What I'm also looking at is I'm trying to estimate the volatility, what it is going to be between the two expiries. And since my estimation, which is known as the forward volatility, if my estimation is that that is going to increase, I'm trying to play this as you have said, that here I'm selling the higher volatility and buying the lower volatility. That's the only issue.
Okay, fair enough, Amit. But I suppose you also have ONGC on your radar. Can you tell us about how you're playing this one?
Yeah, this is a pure momentum play, Agam. As we've seen that ONGC has been moving up very sharply, and there is some strong price action coupled with long build-up in the F&O data. It also gives some support for the bullish view. If you look at the cash volumes yesterday, that was also very interesting, and we have had a very strong volume in the cash market as well. So looking at the F&O data and the cash volume surge, along with the price, obviously with the price action in mind, I'm looking to build a bull call spread in ONGC, in which we will, if the price trends between 270 and 275, I will look to buy the 270 call and sell the 275 call of June expiry, ensuring that the net debit does not cross 5,000 rupees per lot, which also happens to be our max loss in the trade, the theoretical max lot. And we will keep a rupee stop loss of about 2,000 rupees per lot, and we will keep an initial profit target also of about 2,000 rupees, making this trade also a 1:1 RR. And once we achieve the 2,000 rupees profit, we will trail for bigger profits. The margin in this structure is also going to be about 24,000 rupees per lot. So this the view here gets negated if the price action does not support the OI and cash volume surge data, and it trends below 265, which happens to be yesterday's low. So this is a pure momentum play on the ONGC.
Absolutely. And, once again, to revisit the difference between playing a bull call spread and a futures is that to a certain extent, and please, I do mention to a certain extent, a bull call spread also plays very close to a futures. But after it reaches a certain bound, the returns in a bull call spread are not as much as one that you may get into futures. Similarly, on the downside as well, your downside is capped in a bull call spread, and of course in a future it is, it could be as low as the stock could go. So that perhaps is one of the advantages of playing a bull call spread in this case. Amit, a final question on the overall view on the markets, and I know this is slightly out of the syllabus, but just to follow up. Now that we have a lot of events out the way, and in general, just to take a view, do you think that consolidation could be on the cards based on your experience over the next 2 to 3 weeks?
Yeah, I agree. Consolidation seems to be the theme that is playing out after the conclusion of the big event, and things have fairly, barring the 2 days of extreme volatility on the exit poll day and the election result day, we have kind of more or less resumed the trajectory. I do see that there is some bit of resistance at higher levels of 23,500 on the broader index, and till we see any major triggers, I would say that probably if inflation data comes in better than expectation, we could see an up move resuming in the market, and if the inflation data does not come as per expectations, we probably might see a slight bit of retracement in the market. But having said that, I don't see any major trend forming in the market till we hit the results season in the next. So June would probably be a sideways or a consolidation theme to be played out, and we should, as traders, look to capture this on the relatively still high IV levels, and probably look to set up non-directional strategies, or if you are well versed with it, probably a volatility arbitrage strategies.
Fair enough, Amit. We'll leave it at that. Thank you so much for joining us and giving us your views on the markets, and also handing us a handful of option structures that we could potentially deploy.